Fair enough. Stay with us, Professor Debra. Another market view coming in. Tirthankar Patnaik, Director Strategist Institutional Research at Religare Capital Markets, joins in on the phone line. Tirthankar, 6.7% number is not something that the market is going to like.
Yeah, that's right. That's quite right. Our number was 6.4% when we were the highest on the street, and our expectation was that of a $30 billion current account deficit. But at 32, clearly we have been taken slightly, unawares. The number is clearly a negative, and market should take it in that sense. So we will be, worried about the currency going forward. And what has happened is that invisibles here until now, the sort of bulwark for the current account have been coming in, weaker than expected. So that's clearly a big negative.
Right. Tirthankar, all of this week and for the last 10 odd days, we've seen equity markets remain nervous, largely on account of the political certainty in New Delhi. And now with macro concerns back to haunt the equity markets, do you think at least in the near term, we're likely to see a fair amount of pressure on our equity markets?
I think, we've been maintaining that there are two major roadblocks for the markets going forward in terms of the macro. One is growth, where I think the street has to come to terms with the fact that FY14 growth is likely to be lower than expected. Many people are still above 6%. We think the number is, at 5.8 and likely to be lower if the government sticks to its fiscal deficit number. And the second part is, of course, the current account deficit. We've been highlighting it for the last 6 months or so. And the third quarter number is again higher than our expectations at 6.7%. And so to answer your question, market is likely to see a macro overhang. Where I would probably differ with you a little bit is I think the concern on politics is slightly overdone in our opinion. We do not believe that the government is under pressure in terms of existence actually. So, to us the concern remains the current account and growth.
Samiran, you were speaking about the Tirthankar. What's your view? Samiran says worst case 56, best case 53. We see some more reforms. Do you think the possibility of it being 56 are definitely higher than that of it being 53?
So I tend to agree with Samiran there. Basically, we've had a 53 to 55 sort of band for the currency over the last 6 months. Before that, it was 53 to 56. And the wide band is given the macro volatility that we've been seeing over the last couple of months. We believe that this range will be adhered to over the next couple of months. The only overshoots will be temporary in our opinion. So while 6.7 is a negative in that front, the markets were expecting a number north of 6%. So, on the weaker side for the currency, we do expect the number to be closer to 55, probably, temporarily overshooting given what happens with the global macro over the next month and a half. On the higher side, we do not expect the rupee to breach 53 for longish periods because we expect the central bank to come in and build up its depleted forex reserves. Reserve coverage is pretty much near 6 months, and that's not a situation where the central bank would likely to find itself in. So for us, the range remains 53 to 55 with temporary overshoots, and we'll sort of maintain with that. Right now, we will see we'll expect the rupee to trade at the upper band and possibly overshoot for short periods of time.
All right, Tirthankar, thanks for joining in on the phone line with that analysis. Samiran, we were chatting with Professor Debra